Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano, and today we are going to be breaking down what I think drove this particular volatility spike we saw during the day yesterday. A nice little surprise coming at us in the options market, certainly tied, I think, to some larger scale derivatives. So that's coming up on today's episode. Before we get into it, we always turn our attention to our gratitude. And today's gratitude once again goes out to Prince Jackson for sponsoring today's newsletter and video breakdown, as well as to our monthly supporters, Not Medical Advice, Master, Kurt Lusko, Cosmotropic, Deswag52, and Hey Luckies, aka Faithless Looter, for contributing to offset some of my recording, publication expenses, data expenses, especially on a monthly basis. So many thanks to them, and many thanks to everyone who has contributed either in the past or will contribute in the future, even as regards questions, comments, anything of the sort. All of that helps me deliver and put together a better research and publication package here to keep us all informed as GME investors. So thank you very much to everyone for all of your support in one way, shape, or another. So right today, we are going to be focusing on this particular sort of main event, what went down during the day yesterday, and why, I'll say it right, why I think this was actually driven by some broader market events, some broader connected market events taking place via the larger scale, let's say the level 2 derivatives plane, that is in the sense of swaps, and really how that came about to affect GME. So let's start, of course, broader market context, right? We've been talking about this for several weeks now. SPY does look, even though it is pushing these all-time highs, it does look like it is moving into this imminent sort of pattern of potential correction, of retracement, and what it is likely doing right now is distributing this volume that we're seeing onto, let's say, to retail, or say investors that take less of a precise approach, those buy and hold investors, while larger institutions, let's say smart money, can go ahead and reposition to take advantage of this retrace, by using more complex hedging and arbitrage strategies. So, part of that, that we've talked about, a reason why I think that's the case, is when we see the price continuing to go up, chugging up, days after day after day after day, and yet our momentum indicators are narrowing. So that deeper momentum indicator continuing to charge up, but those shorter term momentum indicators cooling off and, in fact, starting to uncross. Now, they're not exactly falling apart. It's not looking, as we've said, like we saw, say, way back in March and April, where we just really fell apart there. But we do look to be getting close to something of another sort of smaller mid-sized correction event, where we could see these sort of very closely clustered, but nonetheless sort of graduated downward support levels tested in terms of essentially going into something like August OPEX. Now, what we saw in the broader market, of course, going into yesterday's or throughout the day yesterday, was yet again, another all-time high and a call wall breach. Now, SwapClear has been really good about publishing some of their research on what call wall breaches. So this particular phenomenon where the largest accumulation of net options market maker or dealer call gamma exposure is superseded intraday or via intraday price action. So that is what we got yesterday. We can see 630 was our call wall. The 630 SPY level was our call wall, and that was superseded intraday by our price action, by options trading, by the accumulation buying, let's say algorithmic trading of the sort. In any case, moved above this, and what typically happens, SpotGamma points this out, is usually one day trailing, we do see bearish returns with respect to such an event. And what we can see immediately is a large repositioning in terms of the options market toward the put side of things. So if we take a look at our data here over in weekly expiries, right? Yesterday, you'll remember we were straight green all the way out into the beginning of August, indicating by and large net call gex, strikes expiries of a net call gex variety. Overall, this typically signals continued low volatility, continued stability in trading, and largely these upward grindy conditions toward whatever our call wall happens to be. Now that we've had a call wall breach, traders have gone ahead and repositioned themselves net puts, right? So they've opened a lot more put positions, closed out call positions. And we can now see that those weekly expiries that were so green going out into the beginning of August are now skewed in terms of puts. They're skewed towards long volatility, and they are skewed towards protection to the downside after having gone ahead and enacted that 630 call wall breach. So what we can take away from this is that, yes, all right, maybe we have institutions going ahead and setting up for a little bit more market volatility to settle in. And interestingly, right, we can see that certain tickers, we're starting to get sort of news that certain tickers are starting to see some of that volatility emerge in terms of, right, small to mid cap equities. So small to mid cap equities, of course, can act as this sort of gate where volatility can flow through, churn up very, very high IV levels, and then allow the options markets in these particular tickers to return to generate outsized returns, especially by selling volatility, in order to offset, say, similar, let's say, what would you say, contrapuntal points of volatility exposure elsewhere in the market. So of course we get SPY, of course, chugging up slowly. All of the major funds are happy. They get their management fees. Let's say retail and retirement investors are happy because they see their accounts going up. But then of course, institutions can funnel internalized volatility. They can position themselves in terms of higher level derivatives such as swaps, total return swaps, interest rate swaps, and then channel some of this volatility at the appropriate times through these small to mid cap equities after internalizing some of this volatility for year after year after year after year, which they have done on multiple occasions. You can see this on a lot of tickers whenever these companies go into an initial public offering. So very curiously, right, we started to see news looking like this, right? So very strange to have a Monday morning and then all of a sudden we just get blasted with news report after news report after news report saying, oh, open door, open door, open door, ticker symbol OPEN. What is going on there? And of course, why do we have this ticker associated with GameStop? This ticker has never shown up in the same sentence as GameStop. It's never shown up in the same article, like paragraphs about meme stocks. It's not part of that original basket so far as we can tell. But all of a sudden, we're getting blasted with watch out for the new meme stock. Open. It's like GameStop, 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 open, GameStop, open, right? Juxtaposing these things in some sort of Hegelian synthesis that if you just kind of repeat the words next to each other long enough, all of a sudden a correlation will somehow develop wherein people will imply that they are causally connected. Not sure, right, exactly what's going on there. But one thing that we do remember going back to these early days where, of course, GameStop, back in 2020, 2021 started going through these very explosive volatility events, typically that were termed, meme stock crazes or meme stock runs. Seems likely that these had to do with higher level institutional derivatives, wherein a particular ticker was shorted, extremely, shorted off its IPO. GameStop, of course, being one where this was the case for maybe about 20 years, went going through multiple cycles of this. So the 2008 squeeze, the 2013 squeeze, and then most recently the 2020 squeeze, maybe even a little bit of what occurred in 2024 with Roaring Kitty's return. But we can see there are several tickers, some which it seems Roaring Kitty potentially was pointing to in some of his more recent X posts, although it's been months since we've seen those surface. But for example, we have right? We have Unity does in fact look like it is starting to move into that type of pattern, right? Coming out of a multi-year, a half decade short off of its IPO values that pushed all the way up to a high of $210 per share, right? So cruising back, not quite there. but we can see a very similar pattern emerge. And now here's Chewy, right? Obviously, Chewy, a very high profile ticker, something going on there, right? These especially suggested in terms of swaps, but a similar pattern, right? Going up off its IPO and then getting shorted down pretty aggressively until, with Roaring Kitty's return, we start to get this return of very sizable volatility. Now we hear Open is being touted. What do we see going on with Open? Oh, it's the same pattern. Go up off the IPO, get to a nice high, and then multi-year, half-decade, short, 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 and then all of a sudden, several weeks of explosive volatility, right? This is something like close to, yeah, this is close to a 10x move in the span of maybe 4 or 5 weeks here. I think this is 4 weeks. So very interesting. Millions and millions of contracts and options traded yesterday. So, right, how do institutions actually manage this? What's going on here? My suggestion is that what ends up causing these, the way that this volatility is packaged away, so long as right the stock keeps moving down, largely has to do with swaps, right? Institutional derivatives. The way that this works, of course, right, because these are never single leg moves, right? Prime brokerages, I would really recommend you check out Ultimator's post on this stuff. Prime brokerages, of course, will go ahead and enter into something like a short swap. Let's say a hedge fund wants to be synthetically short a particular company. Hedge fund will go out, will say, okay, I'd like this swap. They go to the prime broker. The prime broker says, okay, fine, let's do that. We'll assemble this basket of securities. May not be just one. We'll assemble this basket of securities. You can do whatever you want on your side, and we'll take the long side of the trade. In addition to this, at every month, you'll pay us a premium for however long you would like the trade to remain open. And that premium is going to be based on a set amount, either deducted or added to whatever the SOFR rate is. So like the standard overnight financing rate will be used as a benchmark in order to calculate these sort of monthly interest payments. And then at the very end, whenever the swap is terminated, there will be, let's say in the case of a total return, the difference in the values of the securities will be calculated, and there'll be something of a cash payment in order to close out this particular contract, right? So this particular derivative. Now, in the case of the prime brokerage, right, the prime broker doesn't care about the total return. The prime broker only cares about getting that that leveraged interest rate. So the prime brokerage will say, sure, I'll agree, but we'll just go ahead and be delta neutral. So the broker is going to go ahead and hedge that entire position. They don't care about the underlying securities. They just want to isolate that particular rate. Of course, however, as the security or basket of securities, this is what's important, because often these are done as a basket of securities rather than as a single stock. If certain tickers in the basket end up appreciating dramatically, there may be required on the part of let's say, either the prime broker, but certainly of the original hedge fund party. Let's say it's a short hedge fund. The broker may require that the hedge fund appropriately have a sort of cash balance or a margin balance in the event that this particular swap results in very large losses for the particular hedge fund. So a good example of when this was not properly done is in the case of Archegos, right? If an institution like Archegos does not have a margin balance capable of going ahead and meeting the requirements in the case that its bet loses, then even that for the prime broker, in the event of even being on the winning side of the trade, if your counterparty has gone bankrupt, if your counterparty cannot actually pay out the winning side of the trade, cannot pay out your wins, then essentially you're holding on to these worthless hedges that you're taking a loss on. They're supposed to be hedged by the fact that you're getting paid out by your counterparty who's on the losing side. But if your counterparty no longer exists, then all you're doing is holding a really, really hard losing hedge. So that happened in the case of Archegos, much speculated to have also occurred in the case of Credit Suisse, which is continuing to be unwound by the Union Bank of Switzerland. So that's a really good example of what went on there. Okay, so how do you prevent that, right? One way in which you prevent that is you require a certain amount of margin to be held by your counterparty at all times. and for that margin to be adjustable to receive margin calls, so that the counterparty can remain in a position of solvency, at least to compensate you as the prime brokerage for your winning part of the trade. And then, of course, if the trade becomes too difficult, if it becomes too negative, if it ends up challenging, let's say, the entire solvency of the counterparty, then there can be something of a forced closure of positions of the sort, and then things can get really wild. Very likely, a lot of what occurred with GameStop was sort of multiple compounding issues connected to this, right? Multiple compounding defaults, issues with swaps, et cetera, et cetera. So, all right, well, but Michael, what are you doing? What are you talking about? What is all this swap stuff with Open and Chewy and maybe you? What does this have to do with anything? Well, okay, now we're going to come back to this issue of basket swaps. In a basket, even if, let's say, GameStop doesn't go anywhere, if GameStop is in a basket with a number of other different tickers, such as you, such as Chewy, such as perhaps now Open Door, then, and those stocks are all absolutely crushing it, right? They're bulling particularly hard and have been for a while. Maybe two of them, all right, it's okay, you can hold those back. Although, right, you is on its is hard charging and has been hard charging pretty recently. Chewy's fallen off a little bit, but it's also been hard charging to new highs recently. But of course, right, Open Door, this could be a straw that's breaking the camel's back with regard to an institution's particular basket swap. Now, if GameStop is somewhere in that basket, or maybe even in something of an adjacent basket, an institution that's holding some sort of swap, whether it be more recent or a legacy swap on GameStop, may be required to go ahead and purchase shares of GameStop as necessary collateral in order to remain sufficiently solvent in the case of this party-counterparty arrangement with higher level derivatives. So, okay, why do I think potentially that's connected to GameStop? Well, it's going to pertain to when and how we saw this volatility materialize in GameStop yesterday during the day. So if we go ahead and take a look at this run, right, we were pretty flat. We were basically behaving by and large as we have come to expect over the past several weeks with this low volatility environment, historic 5-year lows in GameStop. Until pretty much exactly 1:51 p.m. 1:51 p.m., we see this huge candle, over 500,000 shares, all of a sudden smack into the tape, starting this chain reaction where we first bust up and then ride, and this is key, ride the 20-minute moving average. Intraday volume-weighted average price orders, very often the way to spot them is they will chug over an extended period of time using the 20-minute moving average as an intraday support in a channel until they reach completion. Now, I pointed out, right, this is exactly when we saw this first volume come in. This is exactly when we saw volatility start to spike up. And this is exactly when we saw the price start to move outside of the bounds of what we had seen early in the day in terms of our volume-weighted average price, plus or minus 2 standard deviations in terms of price. This order, which looked very much like a VWAP order, given that it used the 20-minute moving average as a lower bound, did go ahead and stop, right? It reached its highest point and then fell off precipitously exactly, and not a minute later, nor a minute sooner than 2:51 p.m. And it lasted exactly 1 hour. Well, Michael, why does 1 hour matter? Why would 1 hour starting at 1:51 p.m.? Like, what are you talking about, man? Well, if we go ahead and look at the SwapClear margin add-on deadlines, if we look at the schedule by which intraday LCH SwapClear Ltd, so this is the organization that acts as a swap clearinghouse that sends out margin calls in order for institutions who are participating in swaps, parties and counterparties, to make sure they are maintaining significant collateral in the event that the risk model maintained by LCH goes ahead and changes due to certain market conditions. They can and do go out and demand intraday margin calls. So we can see that with Forex, this occurs somewhat earlier in the day at about 1:15 p.m. But equities, of course, swaps on equities occur at 1:45 p.m. And there is a 1 hour deadline for any orders connected to this to be completed. We can see it right here in our chart, right? What do you mean? This is just a chart. What are you talking about? Well, if we go ahead and look at the rule book, what do we see? In certain circumstances, the clearinghouse may require a clearing member to transfer additional cash collateral to the clearinghouse after the closing of the London PPS facilities. In this event, the clearinghouse will require payment of additional cash collateral through PPS facilities in the United States of America. Members must ensure in these circumstances that they are in a position to comply with such demands through their nominated US PPS account within 1 hour of the demand. So what does this suggest based on this time? It suggests that at around 1:45 p.m., they were given a deadline. Hey, you've got to go ahead and clear this. 1:51 p.m., an institution that was short on their margin collateral. They did not have sufficient shares of GameStop in order to guarantee their solvency in the event that their basket swap was not going their way. Went ahead, punched in a VWAP order. It lasted exactly 1 hour. They got what they needed in order to meet their requirement. And then there you go. Volatility fell off, price fell back down. And then the rest of this looks like it was carried on the heels of some options move, of course, attendant options moves, options traders coming in, algorithmic trades coming in and feasting on all that new volatility, which of course moved up by over 10 percentage points in the course of an hour yesterday. So I would suspect, right, especially if we're getting bombarded by all this MSM stuff, telling us, oh, watch out for this meme stock open door. It's just like GameStop, meme stock, open door, meme stock, meme crazy. That tells me, all right, well, that's probably something connected to a SwapClear margin add-on. And of course, where did this tip come from? It came from this particular day that we noticed right back in 2024, right, at 1:45 p.m. on December 5th of last year. We got something like this right at 1:45. All of a sudden, cowabunga, up we go. Of course, a lot more volatile, but a huge move right in the midst of this run that we were enjoying in November and December of last year. Of course, when we were getting pummeled with news about new interest rate hikes. Okay. And of course, who tipped us off to that? Perhaps you'll recognize this tweet, right? Time you covered dropped right at 1:45 p.m. on December 5th. The date, of course, that sticks in my memory. This was the day, in fact, that I was banned from Reddit and that my account was taken down. So very interesting. What I suspect is, at least in part, Roaring Kitty was going ahead and pointing out to us that, yeah, we're about to see some volatility right now, right at this time. How could he know 1:45? Well, I would propose, I would go ahead and make the argument that this is the case, none other than a LTH SwapClear margin add-on requirement that required a very dense VWAP order piggybacked by the options market. And its attendant volatility spike that culminated within 1 hour, according to the rules stipulated in the manual procedures. So it does look like that was in fact the case for our price action yesterday. Now, what would I go ahead and say about that with respect to our price action going forward? Well, I would say that that event was a discrete event that took place yesterday, unless we see these tickers. Maybe looking at you, looking at Chewy, looking at Open Door is a good way to keep a thumb on this. If we see these continue to charge hard to the upside, maybe we could anticipate a similar type event going ahead and materializing in some of the days that come. But again, right, I do think that this type of event was connected to this SwapClear margin add-on requirement. Unless we see those contingent factors, those other factors that in fact were causally linked to this type of volatility, assuming this theory is correct, then I am anticipating that traders will go ahead, despite the fact that they went long volatility yesterday, that they will go ahead and start to package and sell that volatility going in to the next couple weeks. Now, this is, of course, speculation on my part based on what data I have seen, what I have seen very regularly. We did get to very close to a local high, of course, with that peak yesterday, came within a few pennies of our high in the post-second convertible bond offering world. Throughout the day, we did see a lot of net long volatility trades in sizable volume. However, we did not really move out of our previous options structure. We did not flaunt. We did not go outside of the boundaries of our OI and gamma exposure in the short term, right? We did not blow through 25. We did ride a lot of this GEX Options trades certainly pushed some of this and sort of churned up volatility in a way that it may not have otherwise. It does look like that sort of tail recovery up towards 24.20, that 24.20 close may in fact have been options driven based on what we saw. But yeah, I would be hesitant to predict or to offer a prediction of major continued upside based on this single event alone. You'll recall that even after that event last fall and a similar one in January, another what was likely SwapClear event, I think around January, maybe it was like 16th, something like that, that we would see that we moved to the downside after this, and seeing this type of volatility resulted in quite a substantial amount of volatility sales. So we'll have to monitor what that's going to look like intraday. It does look like, yeah, some traders anticipated this, especially at the 24.50 strike, and then went ahead and exited it, at a clean 100% trade there. Very interesting. Some folks out there, I think, went ahead and did it there watching. So, good on you if you ended up in the middle of that. Don't forget to take profits. Not trade advice, but, be careful. Always be careful with long options, long volatility trades. Yeah, but, as we can see, not really looking at too much of a restructuring of our gamma environment. Still looks like we are likely going to be pinned in this 24 to 25 area as kind of an upper bound, maybe even later in the week slipping back into that kind of 23.50 range. It does look like we're already seeing some of that currently. Pre-market, Max Payne really hasn't moved, sticking at 23, going up to 23.50 for next week, but we're not really moving too far outside of what we've seen regularly. So I think in terms of a gift, right, this gift of volatility is something that traders are likely going to go ahead and sell. And unless we get some sort of additional externality, possibly connected to more margin clear events, then we are likely not looking at moving too much outside of these familiar parameters in the 23 or 23.50 area to 25 in the immediate future, right? So always erring on the side of caution. That's what I do. That's beneficial to the way that I go ahead and manage my trading strategies with respect to GameStop. So I would urge you to go ahead and exercise caution in the way that best suits your particular strategies for approaching GameStop. But this, in terms of this, is my outlook going forward based on what I've seen, of course, over more than the past year, and doing more than 200 of these, 200 or so of these articles, almost probably about 250 now. Over 100 of these videos. That's sort of my 2 cents there. So I hope this ends up being helpful to you in coming to a consensus, with respect to your own view of the data, your own view, your own predictions, your own analytics. I hope this, is helpful to you, especially the ways that I approach thinking about some of this. We'll see what happens. Obviously, it'd be great if we see something else, but that's really my outlook going into today's trading. But of course, right, things can develop, and it's important to stay abreast of those. That's why I publish these every day. I work on these every day before market open, just to stay abreast of what's going on with the broader market, and of course with GameStop. So thanks very much, as always, for watching and listening. Look forward to seeing you all tomorrow once again for another open interest newsletter breakdown. And good luck out there with your trades. Good luck out there with your investments, and let's go GameStop. So we'll see you guys next time. Thanks very much.